Hello world, my name's RoZara. I'm a full-stack web developer and a passionate investor. Today I would like to make a video talking about the difference between options and stocks. So I know a lot of my videos are being watched by new investors and people that either don't have any experience at all or don't have an account, or some of them just aren't that experienced. They might have opened the account, maybe they have index funds or a 401k, and they're not too versed in all the terminology and stuff. So I'm super interested in options, and it seems like people ask me questions about options. So I would quickly like to explain the difference between buying shares in a company and buying call options. There are different types of options, and to keep this video simple, I'm just going to be talking about call options. So when I say the word options, that's what I'm referring to. So, first of all, when you buy shares in a company, you are buying a small piece of the company. When you buy a small piece of the company, you are an owner of the company. That's not any gray area. You're an owner of the company, just like the way that if you open up a lemonade stand, you'd be an owner of that company. You are an owner of the company that you buy shares in. So, as an owner, you have the chance to vote at meetings on which direction you'd like to see the company go, such as which directors get hired, maybe compensation for the upper level management and stuff like that, the C-level management. So I would say most people do not participate in these meetings, and they don't exercise their right to vote, which is perfectly fine. If I own shares of Disney, I don't know what's going on at Disney on a day-to-day basis, and so I prefer to leave the decisions to the C-level management and the directors and the people that own much more shares of Disney than I do. So to buy stock in a company is to buy shares of a company. And you can start buying any amount of shares that you want. If you want to buy one share of Siri, the radio company, I think it's about $5 right now. It's in the $5 range, maybe $5.10, $5.20. So, if you were to buy 3 shares of that, that'd be, $15 and change. So you can really go as low as you want to. Just be aware that there are commissions every time that you make a trade. You have to pay $5 at a place like Fidelity. So, you got to keep that in mind. You don't want commissions to eat away at your earnings. So for me personally, every time I make a trade, I try to do a $1,000 minimum trade. But if you don't have a lot of money, I might suggest doing maybe $100 minimum per trade every time you buy. So that's stock. And an option is a contract. So one option gives the owner of the contract, if you were to buy the option, you'd be the owner of the contract. One option gives the owner of the contract the right to buy 100 shares of whatever the underlying stock is at a certain price before a certain time. So if I were to buy one option of Disney, then that contract would allow me to buy 100 shares of Disney at some point in the future. When I buy the contract, I'm going to be buying with a specific strike price. So if Disney is at $104, some common strike prices to choose from might be $100, $95, $90, $85. Those would be in the money strike prices because they are below the level that Disney is currently trading at. And again, if Disney's trading at 104, some common strike prices would also be $105, $110, $115, etc. So you can choose the strike price. And if you choose a lower strike price, then you can expect the price of the option to cost you more money, because there's a greater chance that you will be able to buy your 100 shares of stock for that price. So for example, if I choose $100 strike price when Disney's trading at 104, then for a short-term option, I would expect those options to cost $4 each, or a little bit more than $4 each, maybe $4.50 or $5 each, depending on how short the option's for, whether it's for a couple weeks or a month. So if instead of a $100 strike price, let's say I chose an $80 strike price, that would be considered a deep in the money option, because it's very likely Disney is going to be trading for more than $80 at any point in the future. So I would expect that option, if this was a short-term option, to cost maybe $24. And the way that I'm doing the math is I'm just doing the 104 that Disney's trading now minus the 80 strike price, and that would be $24. So these numbers that I'm talking about, you have to multiply by 100 because each contract is for 100 shares. So the 100 strike contract, let's say, cost $4.50. Because it's 100 shares of stock, it would actually cost you $450. And the $80 strike price, because it's 100 shares, instead of costing $24, this would cost you $2,400. So significantly more money. So people that want to take a relatively smaller risk, they would choose a higher strike price. And there's pros and cons to choosing a higher and lower strike price, which is probably beyond the depth of this video. But I would be happy to answer any questions on that if you wanted to message me or leave me a comment. I'm very happy to talk about that kind of stuff. So that's how the strike price works with options. Now the time until expiration. So the options contract has a particular expiration date. So normally the bigger companies like Facebook, you will have 20 different expiration dates to choose from, maybe 25 or 30 different expiration dates. A smaller company, maybe if the company only has a $2 billion value total, might have very, very few expiration dates to choose from. Every option with a particular strike price and a particular expiration date would be considered one contract. So there's only so many people that are interested in these contracts total. So the liquidity on a bigger company would be better, meaning the liquidity means the availability of trading, the availability of people that want to buy these options and sell these options to you. It's just a bigger market for bigger companies. So usually when I buy options, I tend to buy them on much bigger companies. That way I know that when I buy options for myself to own, I can sell them to someone in the future, and there will actually be real people in the world that want to buy these options from me in the future. So using Facebook as an example, Facebook is trading for about $149 today, or $150 today. So I wanted a very, very long-term option for myself that expires January 18, 2019. So I wanted to choose a strike price of $140. So because Facebook's trading at about $149, you might expect this option, 140 strike price option, to cost about $9, $149 minus $140, or even $10. So that's not the case. Because this option is dated so far in the future, and Facebook has about 18 months to grow, and to grow revenues and to grow earnings. And Facebook could be any price in the future, who knows? So because of the time value, the time until expiration, these options cost significantly more than $9 each. In fact, I have an order, which means I'm offering to buy these options for $25 each, times 100 is $2,500. And those orders aren't even going through. People are asking for $26.25 right now, or $2,625. So they are asking even more than $25 for each one option. So if you were to get an option for strike 140 that was expiring in a week or 2 weeks or 3 weeks, it might be a couple of percent over $9. If Facebook trading at 149, I buy the 140 strike, you might expect to pay $9.25 1 week out, or $9.50 2 weeks out, or $9.75 3 weeks out, just to give you a ballpark, an idea of how it works. But the options I'm ordering, or trying to order, are 18 months away, which is a significantly long time, and I like to buy longer term options. That way, if the stock price does go down, I have a chance for the stock price to eventually come back, because sometimes stuff just goes the opposite direction that you want it to go in. So it's nice to have a couple more months to get your money back. So that's why I choose longer term options. So in this scenario, just to explain a little bit more fully, the options that I'm buying for strike 140 and offering $25 for, let's say at some point today someone accepts my offer and I do buy these options. So now I spent $2,500. I'm controlling 100 shares of Facebook. I have the option to buy 100 shares of Facebook at $140 each. 140 times 100 shares is $14,000. At the moment, 100 shares of Facebook is worth $14,900 because it's trading at 149. And for me to eventually make money, if I were to hold these options until expiration, I would need Facebook to trade over $165 at some point in the future. And the way that I'm getting the 165 is the 140 strike price that I chose, plus the $25 that I'm paying for the option. So that's 165 times 100 is $16,500. So at that point, if I were to hold these options to expiration and Facebook were to go higher than 165, then I would start to make money at that point. If Facebook were to go up to 167, for example, then my options would be worth 27. Now, another twist of options, there's hundreds of twists of options, which is why I'm so interested by them, and so many people are interested by them, is most people do not hold their options until expiration. I will very likely sell my options far, far sooner than 2019. So let's say Facebook, for a couple of weeks, drops down to 140 or 135. Then I still hold on to my options for dear life. I'm a little bit nervous because I spent so much on these options, and I probably didn't have to because I could have bought them at a much, much lower price. But then I stick to my guns and Facebook eventually goes up. And let's say it goes up, 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 up. And let's say it doesn't even get up to 165. Let's say it gets up to 160. But just imagine, if Facebook is trading for 149 right now and the options are worth 25, imagine how much they're going to be worth if Facebook is trading at 160. That's an $11 rise in the stock. And you could probably expect my option, for every $1 that the stock goes up, you could probably expect my option to go up by 60 cents. So 60% of 11 is $6.60. So you could expect my option to be trading for $6.60 more than the 25 I paid for it. 25 plus $6.60 is $31.60, which would be, off the top of my head, approximately a 24% gain, which is the wonderful thing about options. The stock only goes up about 6%, and I would make 24%. So if you'd like to learn more, please message me. I am sorry if I did any of these calculations wrong. Everything is off the top of my head, but I am pretty good at math, so I think they are all approximately right. Message me, and thank you for subscribing. I love you all.